This is a direct comparison of federal income tax burdens. Most Americans pay between 22% and 37% of their income to the government. But according to IRS data, the 25 richest billionaires in the country paid an average true tax rate of just 3.4%. During that same window, their combined wealth grew by more than $400 billion. Real tax return data shows in one specific year, one individual paid $0 in federal income tax, while his fortune grew by billions. These outcomes are not the result of breaking the law. Every strategy we are about to cover is legal, documented, and available to any American who meets the specific qualifications. These tools are used constantly by those with specialized advisors, though they are rarely explained in plain language. These strategies fall into three distinct categories. The first group includes tools available to almost any earner today. The second requires owning real assets, like property or a business. The third involves the specialized wealth infrastructure used to manage significant portfolios. Navigating this system is a matter of understanding these specific mechanisms and how they interact, rather than bypassing the tax code. The first category focuses on baseline strategies, specifically maximizing tax-advantaged accounts. A 401k, a traditional or Roth IRA, and a health savings account can collectively shelter over $30,000 of income from taxation annually, depending on your individual limits. The health savings account, or HSA, is unique because it offers a triple tax advantage. Your contributions reduce your taxable income today, the growth inside the account is tax-free, and any withdrawals you make for qualified medical expenses are also completely tax-free. This visualization shows why the type of income you earn matters. While a $60,000 salary is taxed at ordinary income rates, $60,000 earned from an investment held over a year is taxed at long-term capital gains rates, ranging from 0 to 20%. Depending on your total taxable income, you could pay 0% tax on those gains. The salaried worker continues paying the ordinary rate. Because the IRS taxes the classification of money rather than just the raw amount, shifting how you receive income is the mechanical foundation of wealth building. The second category introduces asset-based strategies, starting with real estate depreciation. The IRS allows owners to deduct a portion of a building's value every year, based on the theory that the physical structure wears out over 27 to 39 years. This chart shows how an investor can claim a massive paper loss on their taxes, even while the property is actually gaining market value. It reduces taxable income by a real dollar amount, while the owner's net worth continues to climb. For a $500,000 property, this can generate a tax deduction of up to $18,000, while the property simultaneously gains $20,000 or more in real equity. When it's time to sell, Section 1031 of the tax code allows an investor to roll the entire proceeds into a new similar property. This defers 100% of the capital gains tax, pushing the bill further down the line. By repeating this sell, exchange, and defer loop, an investor can aggressively grow a real estate portfolio for decades without the drag of a capital gains tax bill. These strategies function by separating a person's actual wealth accumulation from immediate taxable events. The third category covers the infrastructure used to eliminate tax liability entirely. In the buy phase, assets are held as they appreciate. As long as they aren't sold, these unrealized gains trigger zero tax, no matter how much they grow. To access cash during the borrow phase, wealthy individuals use those assets as collateral for loans. Because the IRS does not classify loan proceeds as income, this provides liquid cash without creating a taxable event. Elon Musk is a documented example of this strategy, having borrowed against billions of dollars in stock to fund his operations rather than selling the shares and triggering capital gains. The die phase utilizes the stepped-up basis provision. When an heir inherits an asset, its cost basis resets to the current market value. Every dollar of appreciation accumulated over the original owner's lifetime simply vanishes for tax purposes. It's important to note that the stepped-up basis is an actively contested policy. While it remains in the current code, multiple legislative proposals have sought to change it, making its future a live political question. When executed in sequence, these three steps convert indefinite tax deferral into permanent legal tax elimination. Business owners utilize deductions like Section 199A. For a pass-through business generating $300,000, this provision allows the owner to physically separate and remove up to 20%, or $60,000, from their taxable income. This $60,000 deduction is applied before any tax brackets are even considered, significantly reducing the total amount the government is able to tax. Charitable remainder trusts provide a similar shield for highly appreciated assets. By donating an asset to a tax-exempt trust, the owner avoids the capital gains tax that would have been triggered by a standard sale. The trust then provides a steady income stream to the donor for a set period, while the remainder of the asset is eventually directed toward a charitable cause. Owning businesses and utilizing trusts moves an individual's finances outside the standard employment tax framework. Appreciation, borrowing, business ownership, and inheritance form a unified system that lowers the effective tax rate for those who utilize it. Transitioning from average tax rates to ultra-low rates requires building structural financial infrastructure. Simply earning a higher salary on a standard payroll will only lead to higher ordinary tax brackets. These were the first 7 strategies. In Part 2, we will cover the final 8, including the minority control structures billionaires use to govern massive companies, and a specific strategy involving life insurance used in high-level estate planning. We are picking up with Strategy 8, which operates as the underlying mechanism that makes the most advanced tax avoidance strategies possible at massive scale, the dual-class share structure. When a company goes public, standard shareholders receive 1 share and 1 vote. Founders, however, frequently issue themselves a second, special class of stock. These shares carry 10, 20, or sometimes even more votes each, while representing the exact same economic ownership stake as a regular share. This chart compares Meta's equity distribution against its voting rights. Mark Zuckerberg controls approximately 57% of the total voting power, allowing him to dictate board seats and major strategic shifts, while economically owning only about 13.6% of the company's actual equity. The tax implications of this setup are critical. Selling shares to free up capital normally triggers a massive tax event and dilutes board control. Dual-class structures solve this by allowing founders to indefinitely hold an overwhelming majority of their wealth in unsold, appreciating stock without sacrificing their operational grip on the company. Maintaining absolute control without ever needing to trigger a taxable event is the exact mathematical foundation required to make the buy, borrow, die strategy viable for billionaires. Moving to our Tier 2 strategies, we have Opportunity Zone Investing. This is a federal program designed to funnel capital into economically distressed geographic areas in exchange for substantial tax benefits. If you have capital gains from selling any asset, like stock, real estate, or a business, you can roll those gains directly into a qualified opportunity fund. Executing this transfer instantly defers the original capital gains tax owed. This map highlights how the time threshold works within these designated zones. If the new investment is held in the fund for at least 10 years, any subsequent appreciation on that specific investment becomes entirely tax-free. For handling large, highly appreciated assets outside of those zones, like selling a private business, we look at installment sales. Instead of realizing the entire transaction in a single tax year, the buyer pays in fractions over an extended period. The seller then only recognizes and pays tax on the specific portion of the gain they receive each year. Artificially stretching a massive lump sum gain across multiple years prevents your income from spiking into the highest tax brackets. By staying in a lower bracket, you permanently reduce the total lifetime tax paid, rather than just delaying the inevitable. Entering Tier 3, we find Private Placement Life Insurance, or PPLI. This is a highly exclusive strategy that typically requires $1 to $5 million in upfront premium just to access the infrastructure. The core maneuver takes high-yield assets, like private equity or hedge fund investments, and locks them inside a life insurance policy wrapper. Because it is legally classified as a life insurance product, the investment growth compounds completely tax-deferred. This tax-free compounding environment holds tens of billions of dollars concentrated across roughly 3,000 policies. That represents just 0.003%.
The legislation is designed specifically to strip these exact contracts of their favorable tax status. This live legislative threat proves that the tax code is an actively evolving battlefield. Elite legal structures, even when used exactly as intended, are never permanent guarantees. The backdrop against which all generational wealth transfer is planned is the federal estate and gift tax exemption. This ledger shows where the limits sit in 2026. An individual can transfer $15 million over their lifetime, or $30 million for a married couple, completely tax-free. Any amounts spilling over that threshold are taxed at penalty rates reaching 40%. Transitioning to strategies accessible without a massive estate, we have tax loss harvesting. Any investor with a taxable account can sell losing assets to offset their capital gains elsewhere. If losses exceed gains, up to $3,000 can be used to offset ordinary income. The critical failure point in this process is the IRS wash sale rule. If you repurchase a substantially identical asset within 30 days of the sale, the IRS completely nullifies your tax benefit. For homeowners, the primary residence exclusion is a foundational strategy. If you meet the requirement of living in your home for at least 2 of the 5 years before selling, a married couple filing jointly can exclude up to $500,000 of capital gains entirely. Whether you are managing a $30 million estate threshold or calculating a home sale timeline, maximizing your wealth relies entirely on knowing the exact mathematical limits of the law before you execute a transaction. Our final Tier 3 maneuver for bypassing estate taxes is the family limited partnership, a highly technical process for artificially lowering asset valuations. First, wealthy families transfer business or investment assets into a partnership structure. They then gift or sell minority, non-controlling interests in that partnership to their family members. This chart shows the resulting valuation discount. Because a minority interest lacks controlling power, it is legally appraised at a significantly lower value than the raw assets. This discounts the value by 15 to 40%, letting the assets slide safely under the threshold. By applying this artificial discount, ultra-wealthy families transfer more true wealth through the estate tax exemption than a direct transfer of those exact same assets would ever allow. We have covered 15 strategies across this masterclass. When you zoom out, every one of them traces back to a few underlying laws being applied in different ways. This graphic shows the 5 basic rules driving the entire system. The tax code treats different types of income differently. Unrealized gains aren't taxed until sold. Borrowing is an income. Death resets your cost basis, and business ownership is taxed differently than employment. You must never attempt to execute Tier 3 maneuvers, like family limited partnerships or private placement life insurance, without a dedicated professional wealth management infrastructure. The compliance and structuring costs require genuine wealth to justify. Your objective is to identify exactly which financial tier you are in right now. Then execute one realistic strategy from that tier today. If you are starting out, understand your capital gains rate or check your home sale timeline. Success depends on your ability to flawlessly apply the specific tools available to you at your current stage of growth.